Welcome to The Explainer. For months, it felt like there was only one story in the global markets, artificial intelligence. But just in the last few days, that story hit a massive plot twist. So we're going to break down exactly what happened, why it happened, and what it all means for markets from New York all the way to Tokyo. After a relentless, just gravity-defying rally, well, the music has finally stopped. That powerful AI-driven surge in U.S. tech stocks has cracked, and that crack is now sending shockwaves all around the world. That simple mantra of buy AI at any cost, yeah, that's officially being questioned now. This quote just captures the shift perfectly. The market's moving away from pure hype, from just riding the momentum, to one that's starting to ask some tougher questions. The game has changed. It's not just about finding the hot theme anymore. Now it's about asking, okay, but at what price? So what was it? What specifically flipped the switch? What was the trigger that caused this whole sudden reversal? Okay, let's dive into this. The key here is to understand a concept that investors talk about all the time, being priced for perfection. Just imagine a company is so hyped up that its stock price already assumes it's not just going to succeed, but that it's going to perform an absolute miracle. When that happens, even fantastic news can feel like a huge disappointment. And this is exactly what played out with the market's AI bellwether, NVIDIA. Expectations weren't just high, they were mythical. And what did NVIDIA deliver? An objectively fantastic earnings report. But, it wasn't a miracle. And in a market that's priced for perfection, that's just not good enough. The result? NVIDIA, the undisputed king of this whole AI rally, saw its shares drop by more than 3%. It was a total sell-the-news event and a massive signal that the market's mood had finally soured. And this wasn't just about NVIDIA. Not at all. The selling pressure just cascaded across the entire tech ecosystem. Look at Dell, tumbling almost 9%. And that was despite strong AI sales. Why? Just because its profit forecast wasn't absolutely stellar. The contagion hit everyone from Oracle to the other huge mega-cap giants. All right, let's hop over to Asia and see how this builds, because the reaction to the U.S. tech sell-off was definitely not the same across the board. It revealed this fascinating and really stark division across the whole region. So the fallout in Asia really shows this clear decoupling. Some markets fell right in lockstep with U.S. tech, while others, well, they rallied hard. The region basically split into two completely distinct camps based on what was driving their economies. So first, you've got the U.S.-dependent camp. Markets like Japan and South Korea, which are just so deeply woven into that global tech supply chain, they got hit hard. Chip-related stocks like Advantest in Japan and Samsung and SK Hynix in South Korea, they all saw pretty big drops. The old saying, when the U.S. tech sector sneezes, they catch a cold. But then, in complete contrast, look at Hong Kong, which surged 2%. So why? A totally different domestic-focused story. The Chinese tech giant Alibaba soared an incredible 19%, and that was on the back of its own strong AI revenue. You combine that with some positive manufacturing data, and suddenly you have this powerful local story that completely drowned out all the gloom from Wall Street. But look, all these market moves, they're really just the tremors on the surface. They're just symptoms of a much deeper, much more unpredictable force that is increasingly driving global markets. And the key here is this new term that's dominating conversations, the policy risk premium. What is that? Well, it's essentially the price of uncertainty. When governments and central banks start acting in unpredictable ways, investors get nervous, and they demand to be paid more for taking on that extra risk. And right now, the sources of this risk are just everywhere. We're seeing unprecedented political pressure on the U.S. Federal Reserve, these ongoing erratic tariff policies, and the use of technology restrictions as a weapon in foreign policy. See, this isn't just about economic cycles anymore. This is politics directly hitting people's portfolios. So in this new, much more complex world, how are investors reacting? And what are the critical signposts we really need to be watching to see what happens next? Well, maybe the clearest signal of rising fear out there is the price of gold. It's been surging to prices like this, blowing past key levels. When investors get scared of political and policy risk, they often run to the perceived safety of good old physical gold. This just puts it perfectly. A rally in an asset like gold, which, remember, pays no interest, isn't a search for profit, no. It is the market's definitive statement. It's a direct response to that rising uncertainty. It is investors buying insurance against unpredictable events.
So, to understand where we go from here, the market's attention is now just laser focused on a few key upcoming events. These are going to be the next major tests of investor confidence.
First up is the U.S. jobs report, which is going to be critical for the Federal Reserve's next move. Second, there's a key government bond auction in Japan, and that's really a test of confidence over there. And of course, everyone is going to be watching for any new political headlines coming out of the U.S. And, this complexity, it isn't just happening at the huge macro level. We're also seeing new sources of volatility pop up from structural market changes. In India, for instance, a really technical shift in their derivatives markets has created this brand new high stakes countdown every single Monday. It's just another reminder that in this new environment, risk can come from anywhere, not just from the big political headlines. So, the crucial takeaway from all of this is that the market's fundamental character has changed. That easy ride of just betting on one big theme like AI, it's over. And that leaves us with a really critical question for the future. In a world that's increasingly driven by these unpredictable policy decisions, are traditional fundamentals enough? Or have we entered a new era where investing is really just about trying to predict politics?